All right, a happy morning for everyone. Sorry, I think today we're a little bit late. So I hope everyone is good. And I hope today we have a stable network. Unlike yesterday where we had got a lot of interruption, the networks. So I believe today we may have a fairly stable network, unless otherwise. So I think we are good to go. Good morning, Linda Julius. Good morning, Coach Mupiwa. Good morning, everyone on the call. I cannot mention everyone's name, but happy to have you all in our morning class for today. Yesterday we got interrupted, as I said earlier on, and we're going to go back to the lesson which we were supposed to have yesterday. And the area of discussion as per today, which is a continuation of what we discussed yesterday, is looking at one of the indicator among the different indicators that are used in technical analysis. And this indicator is called the Fibonacci, the auto Fibonacci retracement. Now, the Fibonacci is a tool that you can find it as an indicator on the indicator list, but at the same time, you can also find it as a drawing tool under the section for drawing tools on the trading view. So those one under the tools, the drawing tools in trading view are the manual one. Simply they have designed for you that in that tool, Fibonacci, to use it manually. You could draw it manually, the chart, provided you know how to do that. The one in the indicator section has been designed in such a way that you necessarily don't have to draw it yourself, but rather upon selecting it, it automatically adds itself to the chart and then establishing its fib levels as it is supposed to automatically, so that you're only now left to do a few things, and then you see if at all what you intended to do is matching the expectation of, is matching actually what you're seeing or what you're observing on the chart. So there are two ways. So without wasting time, I think I will allow you to share my screen and I formulate that Fibonacci before we can go and try to use it practically on the chart. So let me do this. So the Fibonacci, I'll begin by first of all building up a background on what the Fibonacci is. Now the Fibonacci is a tool or an indicator that helps in first of all predicting the possible retracement areas, the possible retracement price levels in the market, but generally it is built on an existing trend. It establishes itself based on an existing trend. For instance, if we have a trend that is on a rise, okay, like this, the Fibonacci will provide a benchmark for trend continuation or retracement. So you will draw it basing on an existing trend, meaning you will have a starting point somewhere and then drag it to the point that you want it to stop. And then by so doing that, it is going to establish the Fibonacci levels. These Fibonacci levels are actually what we refer to as the support and resistance. This support and resistance are built based on the previous areas of reaction in the prices. So it uses the data that was generated previously with regards to the different levels, the different price levels that the price has been reacting to, so that it is, it is draws this line, and then it helps to actually use that drawing to predict the possible movement in the market price, the areas of retracement, and the possible areas of trend reversal. So that is what you do. So I'll pick it. I'll begin by using the Fibonacci tool, and I'll explain it after having that. So if you go to the drawing section, you tap on your pencil, and then you go through the drawing tools, you will find the Fibonacci under the section of Gann and Fibonacci. Find it written as Fib retracement. So you just long press like this, and then you tap on this, on the star, to add it on your favorite, so that you can be keeping it under your favorite section and be using it anytime you'd wish to. So to draw it on the chart, you simply, after having identified your trend, if it is an uptrend, maybe before we go to how you draw it, let me just explain a few features on that. The Fibonacci has what we call the Fib levels. These Fib levels are like, they are the support and resistance level. They are actually the horizontal trend lines that are drawn and to establish support and resistance levels on the chart. Now, these Fib levels, you can find them in terms of value, or you can change them to percentages. Okay, the default settings, you may find them as values, but you can go ahead and change them to percentages. Okay, and it depends on how you want it to appear. But the Fib level runs from 0 to 100, and with the Fibonacci levels being, let me just take this back to, let me take this as well. You can have very many Fibonacci levels, but let's take this, for instance. Now, on the default settings, this is how let me just reset it. Let me reset this. So set this. I'd set this in a way that should favor what I want, but I could reset it. Okay, let me just apply default. So on the default, when you go to the default settings for the Fibonacci, for the Fib tool, this is how it will appear. If you go to the default, this is how it will look like. So it is up to you to make adjustments depending on your preference. But what's the most important thing here is that the Fibonacci has those key support and resistance levels already drawn. You don't need to draw any support or resistance when you're going to use the Fibonacci. It has those lines already established. So it's just a matter of picking up the areas of analysis, or the areas that you would want to concentrate in to do your analysis, and then it will draw for you automatically those trend lines or support and resistance. It will just establish them automatically. You will not have to draw it manually. For as long as you've identified your major swing high and major swing low on the chart, and then you've connected the two, the different Fib levels in the middle will just automatically establish themselves. Okay? Yeah, so here, to set or adjust them, I'm going to adjust it to only 0 to 100, yeah? So meaning I'm going to untick all the other levels. Then I save as default. Okay. So I will have only this from 0 to 100. or what we literally refer to as 1. Now, still on the default, you realize that the leveling is on the left, but you could check the level, and the most recommended side, the level is actually on the right. So to do that, simply still go back, you tap on it, and then go to the settings. You will find that here, you have, first of all, a recommendation here, a guidance on as to whether you would want those lines to extend to your left and also to extend on your right. But if you just want it to appear the way it is on the chart, you will leave all this unticked, okay? But if you want the lines to just run horizontal as if it is a trend line that has been drawn using the horizontal line, you can tick both this and then that. And let's see how it will look. For example, if you can tick that, if you go back to the chart, you see how the line will look. It will run continuously and endlessly from left to right. See? To run continuously from left to right. Yeah? So let's go back there. Or let's untick that and let's leave to the right. And we'll see what happens. So you see that it will begin from here. It will begin from here. It's no longer there on the left. It's just beginning from the very point you've released it, and it is running horizontally towards the right or towards the price lane. Okay, that is also another way. But if you just want it concentrated within the area that you have selected for your analysis, you can as well untick, extend the lines to the right. Then you have that. Now, to put these labels on the right, you still go back to the settings, and then you come here. Down, just come down, yeah. Okay. You have, first of all, the manners in which those levels have been made. It is in terms of value, so you may want to change it to percentage so that you have from 0 to 100%, because as we do remember yesterday, we said that the market moves by 100 before actually retracing, for if it is maintaining a particular trend. So the movement by 100 will help us. We would capture it from our drawing Fibonacci, the 0 to 100 before we can see a retracement. All right. So you do that. You change that to percentage. Then about the side to which you would wish the levels to be, you come here. Where is it? You come to level. Okay. So you'll come to this part, tap on it and change to the right. Okay. Just tap that and change it to the right. Okay. So you can go ahead and also change if you want to. The font size of the labels is up to you. Yeah, you can as well leave it on the default. Yeah, you can as well leave it on the default settings or in the default settings. And then, yeah, basically those are the adjustments we can make. And then we go back and see how our fib retracement will look like. So this is how it will basically look like. Okay. So at least now we know that we can capture our market movement by 100% with our Fibonacci levels, or what we call the support and resistance, established automatically. Okay. Daddy. Now. Daddy. Just a minute. Yeah. All right, sorry for that interruption. Okay, so We have our Fibonacci that will help us capture our 100% movement. And in the process of capturing 100% movement, if you recall what we shared yesterday, I was trying to build a background for you to understand what we call the price delivery algorithm, all the phases within which the market has to move, okay, to establish a particular trend. And we said there were about 4. There's what we called the consolidation, then there's the expansion, and then the retracement. Then we shall have another continuation of the trend. We have another expansion and then a retracement. The expansion and retracement are the key stages that appears in the course of that particular trend before the fourth stage, which is the last one, and that is price reversal happens. Okay, so the market has to consolidate, expand, and then retrace. And the retracement is in a bid to build momentum for the next movement. And once the retracement happens, then we have another expansion. And then once the market price loses momentum, it will have to retrace. That retracement will build momentum for the next move. So this will continuously happen until a point is going to come when the market will reverse, or the market price will reverse in the opposite direction and begins moving to the direction opposite to what it was actually moving previously. So it is very key. Now the Fibonacci sets in or comes in to help us identify to capture the 100% movement during the expansion stage, okay? And then secondly, it will help us identify the possible retracement levels in the course of that movement, right? It will help us identify the possible retracement levels within that aspect of the expansion or a continuation of the trend. Now, ladies and gentlemen, let's dive a little deeper. When you look at the Fibonacci, and then you look at these Fibonacci levels, there's this, there's that, and then up to 100. These are actually the resistance. Call them support, depending on where the market price is. Now, if you are trading, you must pay attention to these Fibonacci levels. When you are trading, after having drawn them on the chart, when you are trading, pay much attention to these Fibonacci levels. These Fibonacci levels are the key price reaction levels where the market price reacts to them upon approaching them. Depending on the part any area that you will be entering the market, if you are approaching a particular Fib level, you need to pay much attention, because there's a likelihood that, for example, if the market price was on an uptrend, okay, and a particular support, a particular Fib level has been broken, or a resistance has been broken, possible resistance point will be the next Fib. Assume that will be the next movement. For example, let me just demonstrate this. If we had something like this, I'm now going to demonstrate a price movement, yeah? Let me bring this drawing tool. Let's assume we were on an upward movement. We're going to have this kind of movement, right? Let's say the first instance is a break of structure to establish this movement. And then we shall have a moment of a retracement. Then we have the next movement like this. We shall have another retracement. We shall have the next movement like that, and then a retracement. You know, this is the movement that we are going to see. And then finally, that break of structure, okay? So this mini movement in the long run builds up to what we call the 100% movement in the market price. So this, extending it to the left, to the right, would give you a picture of what I'm trying. This is it. So that at every point when there's a break of structure, okay, when there's a break of structure, you should expect the next rejection to happen in the next Fib level. Then if the next rejection happens, just know that the retracement will come back to the previous Fib level, which was acting as a resistance and it was broken. In this case, it will be supported, and then the next break of structure will happen, then the next resistance will be encountered. Then there will be a pullback to the support, and then another break of structure continuously. So for as long as this market is on an uptrend, that is what you're going to see, okay? Now, if you're a trader If you enter at any point in between these fib levels, take your profit to the next fib level, which is the resistance. If you enter here, take your profit to the next. If you enter at this point, take your profit to the next resistance. So you're not going to take your profit from this point and then just expect to take profit up to there unless you're willing to wait for some time. It will hit there, but it will take a while. But most of the times, if you want to take those mini profits, okay, continuously or progressively over a long period of time, aim at exiting at the next resistance level on the fib level. Okay, you aim at exiting at the next fib level, which would be your resistance. Now, this Fibonacci, if you're trading using the Fibonacci, there are what we call the golden ratio levels, the key retracement levels on the Fibonacci. The key retracement levels are actually three. These are the areas after the market price moving by 100% where you should expect the price to reverse to before it can continue in the previous trend. This is what I mean, that if a movement is by 100%, expect the market price to retrace. But for you to know where the retracement will stop or will end or is most likely going to end, you should know the possible key retracement levels, which we are calling the golden ratios. This golden ratio, all these key retracement levels on the Fibonacci are actually three. The first one being the 38.2%, the next one being the 50%, and then the last one being the 61.8%. These are the three key retracement levels in the market. All right? They are the key retracement levels in the market. So the Fibonacci helps you to capture and locate them. Okay? Because you will be so much aware that if this market pumps, if this market moves by 100%, I'm going to expect a retracement, meaning there will be a pullback. Now, this pullback will always happen in an attempt to build momentum for the next movement, right? But which would be the possible points where the pullback will stop? Sometimes if you don't have some of this Fibonacci, or if you're not using the Fibonacci, you could just establish those those trend lines, the support levels, yeah? You will just have an anticipation that, okay, this is the support level where I think the price will reverse to. This is the support level I think the price will reverse to. But having the Fibonacci tools will add some level of confidence. You will just automatically know that no matter what, the price will reverse within these three. Any of these three is where the price will reverse to, or it will pull back. So meaning, if you were prepared to make another entry, you would set your entry price within any of the three. First, if you say you're going to establish your entry point at 38.2 fib level, you will know that, yes, it is the likely point, that it is the point where the market price is most likely going to reverse to. But don't forget that you have the next one, which is below it, which is the 50. And you have the third one, which is the 61.8. So meaning if you set your entry price at 38.2, also put at the back of your mind to capture this area within the 50 and 61.8. Because this time, as the market price is pulling, it may not pull at the 38.2, but rather it may dip below it and then it is maybe reverses at the 50%. Or it may even come and reverse at the 61.8. So to be safer, if you set your entry point or entry price at 38.2, measure this distance, okay? The percentage you're going to get here is what you should go and establish for your margin call drop, so that in case the robot buys at this level and the market price still continues to dip, once it approaches the 50%, the robot will buy. Once it it also dips below the 50, and maybe this time it goes up to the 61.8, the robot will still buy. So that by the time it is reversing, at least the robot would have bought this level, it would have bought that level, and then the first initial level, so that you have an accumulated position which will be positioned to give you some good profit. Okay? But the most important thing, the key retracement levels are these three. Now, also know that sometimes, depending on how the pullback is happening, depending on the on the volatility of the market, sometimes the pullback may come and not exactly be at the point you expected it to be, not exactly at the 38.2. It may dip slightly below, but in between the 38.2 or the 50. These are still the areas, the possible areas we would have projected. The same applies to this point. Sometimes the pullback may come approaching 50 and it doesn't really touch the 50, but rather go below it slightly, and it reverses in between this area. It is still okay. And the same applies to the 61.8. Sometimes it will go slightly below the 61.8, okay? And maybe midway, and then it reverses and maintains the previous trend, right? But a moment you realize that the market price has gone below the 61.8 and it is now at 78.6, just be rest assured that that is no longer a retracement. It is now a trend reversal. I repeat, a moment you realize that the pullback, which you anticipated to have occurred at 38.2 or at 50 or at 61.8 doesn't happen like that, but rather it goes below the 61.8, and let's say it touches the 71.6% fib level, just be rest assured that that is no longer a pullback, but rather it is a trend reversal, meaning the market has now changed direction and it is going to go in the opposite direction. Is that okay? Did it make some sense? Is that okay? Yeah? A moment, the retracement which you anticipated to have occurred at 638.2, at 50 or 61.8 does not happen the way you anticipated it, and it is now at 78. Just know this trend has changed. This is no longer a retracement. It is a trend reversal. Meaning, if I thought that the trend was going to continue, I should now begin thinking twice, and now either exit the market or take the little profit if I'm floating in it. The little profit and wait, or look for another coin. Yeah. Sujata, the hours can be in 1 hour. I mean, the time frame can be 1 hour, or even 30 minutes, or even 15 minutes. It just depends on the one of your preference. But normally, it's good to do it on a 1 hour time frame so that you can try to eliminate some of those noise that will that you will witness in the lower time frame. Let the lower time frame just help you in identifying trade entry, yeah. But do the analysis on a higher time frame and relax. Yeah. So if that is okay, let's proceed. Let's proceed. Where? Let's come back here. Okay. So I hope that is okay. Now, because of that, me personally, what I normally do is, because I know that my key retracement levels are 38.2, 50, and 61, I tend to hide out or remove this level and that level. You find that most of the times on my chart, I may only have the Fibonacci having only 5 Fibonacci levels, which are this, this, this. Only 5. Why? Because for me, my interest is capturing this movement, then a retracement which will happen either here, then I have that reversal, or here, then I have that reversal, or there, then I have that reversal. So I want to monitor through this trend to see if at all we shall have a trend continuation or we shall have a reversal, because the moment I see that the price has now dipped greatly below the 61.8, I will now conclude that this is no longer a retracement, but it is rather a trend reversal. So that is what will happen. But it is also okay to leave those, the 7 to 8% fib level, and then the 20, this other 23% fib level. It is okay to leave them. Okay, just okay to leave them. But that is what I normally do. But nevertheless, as you also use that, sometimes it will help you in capturing those mini movements as well. So just have it the way it is. Now, let me tell you let me now give you an insight on how you draw this Fibonacci on the chart. If you want to monitor through an uptrend market movement, you want to draw the Fibonacci in an upward market movement, you simply first have to identify the swing low being the point of trend reversal to begin the uptrend, the upward movement, right? This is what we would refer to as the swing low. That moment where the market price was on a downward movement, and then it encountered a support which successfully supported the price, and then it had to reverse and begin moving upward. So this is what you're going to do. So you will identify a swing low. Then you have to first of all wait to capture the first movement, right? Because I said that the Fibonacci actually depends or relies on an existing trend. Now, because it relies on an existing trend, and because we want to analyze what is most likely going to happen in the future, we have to wait for a trend to be established, and then we use that trend to predict the next movement. Is that clear? You use it to predict the next movement. Okay? Now, this is what you have to do. One, you identify the swing low, then identify the swing high. Then draw this line. Now, I'm showing you how you'd use the manual. We're still on the manual. For the auto, that one comes automatically. For the manual, that's how you do it. You identify your swing low, and then you identify the swing high. Then tap on the Fibonacci retracement, put it on the swing low, okay? And then drag it upward to go and touch the swing high. How do you know a swing high? You will know a swing high after having identified this upward movement in the trend and then a retracement. So if the market is undergoing a retracement, okay, you will identify, of course, with the reference to your market price, you will identify a swing high, a price level which is slightly higher than the current price, yeah? A point within the chart that is a little bit higher than where the market price is, okay? The highest price that was registered so far. So you establish that as your swing high, and then you'll have the swing low, which I told you is that point of reversal to maintain this, to cause this kind of movement. So you will just connect the two, you put your Fib retracement tool here, then you drag it upward to touch on the swing high. Now, after having done that, you're going to have the Fib levels established. So even you now tell at what point or at what Fib level your current price would be. Let me demonstrate that here. Where is the chart? Okay. Let me just do this. Okay. It's beautiful. Mm. Oh. Okay. So let's use this as an example. I want us to use this as an example. Let's use this as example. This is to capture this movement. The movement from here. This is an existing trend that was moving downward, right? This was a downward movement in the market price. So we want to establish this. This would be our swing high. Then this point will be our swing low, because at least we are experiencing a reversal at this point. So what we're going to do, for us to draw our fib retracement on this trend, we have to capture, we have to base on this downward, this first trend, this first movement. So we're going to pick our fib. Let me just show you this. You could even just demarcate it. Just mark there, mark here. At least you are marking your you're marking your swing high and swing low. Then you're going to pick your fib retracement, and based on the previous movement, yeah? Just based on the previous movement, not the current movement. Put it there, then pull it below, pull it down. Pull it down. There. Like that. Pull it like that. Huh? So do you see something here? Do we see this? Do we see this? Now, let's see this. This was a downward movement, right? This was a downward movement from here to this point. Actually, this was the first movement. Let me just adjust this. This was the movement. This was the movement here. Now, do we see this move? Do we see this? This is like a double bottom, right? But this is not the first point that the market price had to touch our swing low. The first touch happened when the price dropped to this point. I don't know whether we see that. Do we see? The first touch happened here before actually the second touch. Do we agree? I don't know whether we see that. Did we see that? That the first touch happened before the second touch. Yes. Now, if it is true, that means this movement is what we were focusing on from here all the way. Actually, let me even do this using this drawing tool. We had this first movement, this, all the way to this point. Then there was a pullback. Then we had this mega movement, which touched that point. See that, right? Now, after that touching, this is where our retracement would be like. Okay, now after that, I believe we see this movement. We see this retracement. Do we see this retracement? After the market price touching this swing low, we had this pullback. There's this pullback which happened in between 38 and 50%. If you look at the wick of that candle, that was a pullback, right? That we had that movement, then we had a pullback at that point. After that 100% movement, we had a pullback. Then we had a movement which seemed like a continuation of this previous trend. I don't know whether we can see this. It appeared as if we were going to have a continuation. Had it been that this price level was broken and then we had a break of structure below this price level, then this trend was going to be a continuation of this trend because we had that movement before the retracement, so we expected another movement in that manner. But in this case, after the market price touching this point, okay, we had a pullback or a retracement, which this time, this price level was able to support the price. It prevented it from breaking below, but rather there was a change in market direction. Now, this change, once the market price reverses and then it encounters a second support, if it was on a downtrend, we would experience what we call a trend reversal. Now, once a trend reversal happens, what we should expect is that the market price is going to come back to the previous point it started from, or it will even go above. I don't know whether that is making sense. I don't know whether it is making sense. But expect that the market price is gonna reverse, because now this is a trend reversal. You should expect that the price is going to come back to this very point or even break above this price level. Because the first cycle of movement was interrupted by this second support. Because we expected that this price was supposed to maintain the downward movement, it should come here, should move by 100%. Of course, you see, this was a movement by 100%. Then there was a retracement to the 38.2% Fib levels, and then there was an attempt to have a continuation of the trend, but it was supported here. Then there was a trend reversal. Now, this trend reversal, once it has happened, then we expect the market price to come back to that starting point or even above it. Now, how do you tell that it is a trend reversal? A trend reversal should be confirmed in two ways. One, there should be a second support right after the first support that resulted into the 100% movement. There should be a second support. Then what should follow next is a break of structure above the retracement level. You see where the market price retraced? There should be a break of structure above that retracement level, right? And you know the rule of a breakout. A breakout happens in such a way that a candle has to build from below and close above. Then another candle has to confirm it by opening above and closing above. You'll say that is a break of structure. And that is exactly what happened here. So we expect that this is a successful break of structure. So definitely this trend appears to have changed direction. We are no longer in a downward movement, but we are now in an upward movement. And you should expect this market price to move all the way back to this point or even above. That's the first instance. Is that okay? Is it okay? Is it okay? Use English. Okay. 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 Is that okay? All right. No. What do you mean no okay? Yeah. Yeah, price action is key. Price action key. Understanding support and resistance is very important, and that is the real price action. Let me repeat one more time. Let me even add in some ingredient. Let me add some ingredient in it. When you want to use the Fibonacci, when you want to draw the Fibonacci, I'm using the manual. When you want to draw a Fibonacci, you see this movement. This is super beautiful movement, which is going to give big profit for this for those trading this coin. And I think we don't. Do we have this coin in RoyQ? Oh yeah, I think yes. Hey, this is a super movement. Super movement for AIXBT. It is there in RoyQ. Super movement that will give 7%. We are on the call. We shall attest to this. But what I wanted you to know is this. If you're using the Fib retracement to analyze the market, I told you, first of all, yes, you will not run away from the aspect of the price action of the support and resistance, right? But then you have the support and resistance already established for you on the Fibonacci tool. As long as you mark your point right, you will have those lines already established for you. Now, this is 1 hour time frame. I want us to check on something. I want us to look at something. This is 1 hour time frame. Okay? This is 1 hour time frame. And being a 1 hour time frame, you should expect that if you establish this Fibonacci very well, if you draw our Fibonacci very well, and we have this support and resistance levels established automatically, which we refer to as the Fib levels, if you go to a lower time frame, it is going to make a lot of sense. You're going to see the mini movements actually respecting these price levels drawn. And I told you the second point is that when you're using the Fib tool, when you're drawing them, you have to base on the previous trend, meaning identification of a previous trend movement is key. Just identify how the market was moving previously. Draw your fib on that previous movement so that you can have a view of what is going to happen in the future. Okay? Use the previous movement to draw your tool, to draw the Fibonacci, so that once those lines are established, you are able now to monitor and analyze the future movement or predict the future movement. And in this case, I said, the best way of doing that is capture a smaller area. Don't use a very broader area to analyze the market. Just pick a portion. And picking a portion would mean you picking just, narrowing your analysis on a very small area, a very small scale area. And in this case, we said, we picked this as an example, that we are going to concentrate our analysis only on this mini movement. That is where we're going to narrow our analysis on. And we said to do that, we need to identify the trend. And in this case, this was a downward movement. Remember, we had this movement, then there was a pullback, okay? Now we want to capture this movement, okay? Which is very good. So we shall narrow our analysis just here. Now, as we do this narrow our analysis, we need to make sure that we first demarcate our support and resistance area. And demarcating the support or locating the support and resistance area would require us just marking it with a line, okay? So that by the time we are dragging our fib indicator, we capture exactly the point we have demarcated or we have allocated. Located, not allocated, but located on the chart. So in this case, in respect to this movement, this will qualify to be our swing high. Swing high being the highest price movement registered in the course of a particular movement in the market price. Like we saw, pullback, then there was a retracement. In this case, this was our swing high, because if you look at it in respect to this movement, it is the highest price registered. The highest price level registered. So in this case, we shall put a line there to capture the swing high. Then we come down and look at the swing low. We establish the swing low. And in this case, we said our swing low would be this one here, okay? And let's just magnify this. So we pick a line and put it exactly on the wick. Do you see that? Actually, this other one didn't even touch. If you look at it keenly, this one didn't even touch. It just came close to touching. So this one qualifies to be our swing low. Now, after identifying your swing low and your swing high, okay, you're going to base on the previous, or you're going to base on this movement here to draw your fib retracement. And because this was a downtrend movement, you're going to begin drawing your fib retracement from up, and then you just drag it down to touch on your swing low. Why? Because this was a downward movement. So you follow the trend. The idea is following the trend. You base on the trend, yeah, to draw the fib retracement pull. So because it is a downward, we're going to pick it from up, and then we pull it down because it is a downward movement. So here we're going to do this, pick this, and put it up there on the swing high, and then bring it to the swing low. And you can just pull this. There we go. So with this regard, we had a 100% movement. See this dotted line? The line is telling us that from here, we had this dotted movement. This is a 100% movement, if you can look at the dotted line. So that is a 100% movement from here to the swing low. Then after touching our swing low, as you can see the movement of the market, how it was, we had that movement from here. We had a very big pullback, a very big move. Then there was a retracement. Then we had the next movement, which resulted into a 100% journey. Now, then we had now a retracement. Now, this retracement happened at the 38.2, but slightly above it, of course. This is still okay because, as I said, it can be exactly at the spot or it can be slightly or in the area, in the area in between. It is still okay. So this pullback, we expected that should it have been that it is a downward movement or the trend was still continuing in a downward way, we should have expected that a break of structure should happen here, like it did happen here. If you can check here, we expected a break of structure to happen here. You can see here, this was a break of structure, okay? Break of structure from here to form this, then we had a retest on that structure, then another break of structure to form this. So there was another retracement, so we expected another break of structure past this, maybe to around here. Then we had a retracement, retest, and then we continue. But what happened here was that after the market price touching this support, we had a retracement. Then there was an attempt to break, but it did not. The price was supported successfully here. Then we had this movement too. Now, this movement here, this failure swing scenario brought about a trend reversal. The failure swing scenario here brought about a trend reversal. Okay, that. So there was a failure swing here. So this one confirms that the trend has changed. Now, because the trend has changed, for us to know that the trend has successfully changed, we should monitor this movement. We see this continuous formation of the candlestick, the bullish candlestick. It broke this structure. It broke this resistance level where the pullback happened previously. And after breaking that, we had this mega movement. Now, for us to ensure that this trend is really on an upward movement, we're going to see another candle that will form here. And then it will continue breaking structures and above. This would mean that this trend is on an upward movement. But in a nutshell, the most important thing to put at the back of your mind when you're trading the Fibonacci is that pay much attention to the three key Fib levels. Which three key Fib levels are 38, 50, and 61.8. Those are the key Fib levels you should pay much attention to. Okay? Here, we saw a respect. There was a respect of the 38.2. Okay? So there was a retracement to that point. Then there was a second support, and then this time there was a break of structure above the 38. So meaning this trend is actually on the verge of having that kind of movement. However, as I told you earlier on, that when you see a break of structure, the best thing you can do is trade within the Fib levels. Take profit within the Fib levels. Don't assume that the price is going to move all the way. But if you confirm that other indicators are equally telling you that the trend should be on an upward movement, that's when you can go ahead and increase the level of your confidence and stay longer in that trend, meaning you'll have a moment of waiting until that take profit is achieved. And here, of course, the best tool I like using to increase my level of confidence is actually that. The stock, where you this, I would like to see what is happening there. Now, in this case, you see where we are? You see where we are? On the stochastic RSI, our moving averages, both the signal and then the D line, is within the overbought region. So meaning there's a likelihood of two things happening here. One, the 7.1% may be hit, or this time we may see a respect at the 61.8%, and then we have the market price having this kind of movement again. Okay? But then what you also need to do, to also put at the back of your mind is, even when the market price is in, I mean, when the stochastic RSI indicator is telling you that the market price is within the overbought region, this is in the 1 hour time frame. You can still have a moment where this people will still stay within this region for some time as they wait for the build-up of this percentage, not the position to reach that level before you can see a reversal. Because if you go to, for example, in the 4 hour time frame, you should be in position to know that within the 1 hour, it is telling us the market price is already within the overbought region. But then in the 4 hours time frame, it is still telling us that we are just on the verge of heading towards the overbought region. So meaning in the smaller hour time frame, what you can see within the smaller hour time frame, if you go to a higher time frame, it increases your confidence. What you're seeing here as the market price being within the overbought region, okay, you may see a moment of retracement, okay? You may see some candle building up there and it would be basically a bearish candle, but it will be in an attempt to just retrace within the mini movement, but it will finally hit this take profit, okay? Because in a 4 hour time frame, we have a positive sign or a positive signal, okay? Yeah, so basically that is how you use this Fibonacci tool. Retracement will happen at 38.2 or 50 or 61.8, okay? But the moment we see a candle goes past the 61.8% and it goes into the 70, okay, into the 78, and then that is the point we can then conclude that this is no longer a retracement, but rather it was a trend reversal. It was a real trend reversal, okay? Okay, so that is on the manual. I'm going to go onto the auto one and how we can use that. So was that part okay? Okay. So you may not have to mind so much. If it didn't make sense to you so much for today, you can attend frequently. The more you follow it up, the more it will become easier for you. Sometimes I'm just fidgeting to find ways of making it appear simpler. That's why, but I don't want to use more of the technical term. I'm just trying to simplify it. I want it to be simpler. Just want it to be simpler. Yeah. Okay. All right. So that is how you use the manual. You use the manual to draw on the chart. You based on the previous trend, connect your swing high to your swing low. You will have your fib levels drawn. Then you base on the fib levels to see what happens. Like what we have already drawn, you can now just leave it there and see how the price will be moving will be respecting or reacting to these fib levels. Yeah, you'll see how it will be reacting to the fib levels. But it's a good thing. It's a good thing to draw and then just wait. Okay, you draw and wait. You draw and wait to see what happens. Now, the last bit is when we are using when you're using the auto. Now, with the auto Fibonacci retracement, that one just draws those lines automatically. It will identify for you what the previous trend was like, and then it captures that movement and draws the Fibonacci levels automatically. So it is up to you to now just make follow-up on that movement. So let me remove this. Let me remove this manual. And then we see. Let me go to the auto. So to get the auto, you go to indicators. Then you tap on auto fib. And it is here. It is already on my favorite. So you tap on it and it will be loaded on the chart. Okay. It will be loaded on the chart. So there it is. Now with the auto, it also has several fib levels. It has several of them. You can go ahead to customize it, or you can decide to leave it the way it is. You can go ahead to make some adjustment. Now, this is not the default. This is the one that I've customized the way I want it to be, okay? But if you go to the default settings, you'll have to make adjustments because you're going to find the value on the left, like we found when we were using the manual. Okay, you will find that the labels are in terms of value, not percentage, which you will also still have to go and make adjustment. So as simple as that. So this is now the final. Okay, but if you want to if I can reset the settings, you to have a picture of what I'm saying. This is how the default one looks like before you making the settings or making the adjustment. This is how it looks like. Just have the values on the left, and if you can go ahead to make some adjustment. The first one being on the sides in which you want the lines to extend. Like in my case, I want it to run from the point I am drawing it, to capture it from, use based on the previous trend movement to draw the trend line, let it run horizontally towards my right. But you can as well tap on this on the left so that you see how all the points that it is going to be touching. Because remember, the lines are drawn based on how the previous market movement was like. So it is basing on that movement to predict the future or to draw these future price levels so that you're able to monitor through how the price will react to this line when they eventually come or reach there. So you can just do that. Then you come to the levels. You can change them percentage. Then when you come to the fib levels that you may want displayed on the chart, there are very many. It's up to you to choose which one you want. Now for my case, I will be unticking some. I don't want this, so I'll untick it. I will also untick which one? I'll untick this one, and I will untick that one as well. Okay, let me leave that. Then up on the negative side, I will also tick this and that. Yeah, so then I will save as default. Then I say, okay. Now the aspect of that is the side in which I want the levels to be. So it is on the left. I will tap here and make it change to the right and save as default. Okay, so there we are. So that is it. So that's how it will appear. That is how it will appear. Okay, that's how it will appear. So as we all know, this was the movement, which is not very different from the manual. This was the first movement that resulted into the 1%. Then we had a retracement to the 38.2. Then we had a little pullback in an attempt to maintain the previous trend, but then there was a second support, and now we saw a reversal as it was confirmed by the break of structure above the 38.2, which previously rejected the price movement. Okay, so that means we are having this moment of pullback by that candle, but what we're certain about is that this price is going to come here. It's going to hit the 1%. And I told you that will be about a 7% movement. That is, percentage. Okay? We're going to have roughly about a 7%. But then, as I told you, also as a smart trader, just be trading in between the fib levels. Take profit in between the fib levels continuously. So if you enter at any point here, like at current price, make this your target. Make the 78.6% as your first take profit target, and you'll be good, because expect this movement to happen. Expect this kind of movement to happen. Like what is already happening here, this will come. It may be rejected, at this 78.6% fib level, in which case it will have to retrace before it actually breaks later on. But if it is for a later take profit that you want, the long run take profit, which is the 7%, you can stay longer in the market. Even if it hits the 78.6 and it retraces, just remain in the market for the next movement that will finally give you the 7% or so. But if you want to take smaller profits along the movement and take advantage, just be trading within the trend line. Trade within the trend line. Okay? Trade within the trend line. So, for example, in this case, if you were a smart trader, from the look of things, you can set your entry point, your entry price at this level. This is a 50%. You can set your take profit there and trade within this. Okay? Or you can enter at current price, not just to miss out, because there's a likelihood that you may even not reach the 50% fib level. Okay? You can just enter at current price, then measure that distance to the 50% fib level as the margin call drop for the first call. Just that is like what we call preparing the mind, or preparing for eventuality of what may happen. So then from that, you measure the distance from entry price all the way back to the 78.6%. Okay? So you either set your entry price at the 50% fib level, in which case this will be the preset. The price within that particular fib level is always put in bracket. So if you want to set entry price at 50% fib level, you don't have to bother looking at the price lane. Okay, you don't have to bother looking at the price lane. What you can only do is look at what is already in bracket in relation to that particular fib level. That is what you will do. Just look at the price that is within the bracket on that particular fib level, because all of them have prices. So it shows you the part on the price line where this line will be touching. You don't see it physically, but that's why it just puts it in bracket. It means that this line running, it will come and touch on this, on the price line, it will touch on this price. This 61.8% fib level that is running, it touches on 0.44069% price level, like that. So it gives you the price at which the fib level will be touching on the price line. So you don't have to strain your eyes looking out for what particular price level that is. Just look at the bracket and set whatever is in bracket as your preset price. So that is what is going to happen. So that's what you will do. Okay, that is what you will do. Just based on that, set a preset price or enter current price, measure the distance between the entry price to the downer fib level to establish your margin call drops. So that would be that. Then this measuring the distance from the 50% fib level to the 38.2% fib level. That will be another margin call drop for a smart trader. So we'll continue to do that, but I know it will not come to that. It is just doing a moment of retracement, but it will go up because in 4 hours, we are showing good sign of positivity, but that is 1 hour. That's 1 hour. Go to 30 minutes. That is what is happening. Go to 15 minutes. That's what is happening. It will always retrace, but it will always pick up. Okay? It retraces and picks up. So that is it. That is it. Ladies and gentlemen, that is it. Yeah. For any other thing, man, you can go. You guys can do more research. Eh? Do more research, read more. Yeah. But basically, that is the basic I could give for now. You are not here. Okay. I hope that is okay. So, ladies and gentlemen, let me stop there. Let me stop there for today. I believe you picked something on how to use the Fibonacci. It's one of my favorite actually. I like using it a lot, the Fib and then the stock. I love using them so much. Sometimes I get lazy to draw those support and resistance, so I base on the Fib so much to establish those support and resistance level, and it's one key thing that helps a lot when you're doing analysis. So thank you very much for all who have been who were able to be part of the training. Hope you join the next call for what will happen then. So Leader Julius, I think for today, that's the much I can share. So possibly tomorrow is Friday or today. Oh, today is Friday. Okay. Hey. Yeah, then that means we may, God's willing, meet next week to have a continuation of what we have not covered. But keep practicing. Keep practicing. I told you we may not cover everything, but the basic we give you, you can go ahead to now perfect. We just give you an insight on what you could do as a trader to keep up with what is happening in the market and to have some skill that will live with you forever, so that you don't oftentimes be dependent on the signals, or if the signal is not dropped, you feel like you cannot trade. No, it's just an insight. So you can go ahead, perfect your skill in a particular area, and then you have some leaders around, you can contact them to improve on some of the skills. The uplines are there, your mentors are there. Come on, disturb them. Yeah? Disturb them. A little disturb them. Because if it were like we would do one-on-one, then it may be impossible to help everyone. So sometimes we just give you an insight on what you could possibly do. And then when you go out after the call, you go and practice it. You box your mentors, your upline, try to engage them. Try to engage them more, okay? Engage them more so that you can learn, especially for the newbies. Okay, you can learn from them. Yeah. So thank you very much for listening and for being a good audience. I may give a chance just to two people, since it is a Friday. Just a chance to two people who may have a supplement or who may have a query, and then we shall call it a day. I'll hand over the mic to Coach Julius. Then we call it a day. Yeah. So if at all there is any who may wish to say a word, then you're welcome. Just two people, the lucky two. Yeah. So yes, Semuju, Semgabi, Semuju, yes, Semuju.
Yes, a very good morning, coach, and everybody on the Zoom call. For me, I want to say thank you so much because I have been underestimating the money fib. I usually use the auto fib to do my analysis, and I usually focus on the pocket area of 61. That's where I usually make my entry from. But my question is that whenever I set a preset price, because I usually set a preset price on the 61 pocket area, in most cases, it doesn't hit there in most cases. But in some cases, I find that it hasn't reached the exact preset price that I set, but around there, around the area of 50 and 61 point something pocket area, the robot is, and sometimes it disturbs me a lot. I don't know whether I should now set my preset price in between and not make it exact at 61 the pocket area.
Okay. Yeah, thank you very much. I think from what we shared, I made it very clear that the key retracement levels are three. However, sometimes the market price may slightly, depending on the volatility of the market, sometimes it may slightly dip below the anticipated fib level you expected it to what? To retrace to. Or sometimes it will come closer to touching the particular fib level you had set your preset price at, and it reverses and goes up. So the most important thing is to capture the area. Put your focus in the area. That's why I said the best strategy, if you're going to base on the fib, is for as long as you see the market price pulling back towards the fib levels, take advantage of the first fib level, which is the 38.2%. If you can enter at that point and then just measure cover up, measure the distance from your entry point, pull it down all the way to the 61.8%. The percentage you get around there, distribute it for your margin call drop, so that in case, in fact, doing that, you'll be more safer. You'll be more safer. Okay? The market price will definitely drop to your preset. It will buy, and then in case it dips below your preset, you still have opportunities to buy the different levels, because you would have set your margin call drops covering all that golden ratio areas, the 38 and the area in between, the 50 and the area in between, and then the 61 and the area in between. So you would have captured that. So you wouldn't be so much worried, and you wouldn't have some of these incidences of the price not dipping to your preset price. So you can set a preset price at the 38.2 or slightly above it, just slightly above it, so that the robot can buy that. Then quickly measure that distance from where you have set your preset price all the way to the 61.8. Let me demonstrate this. Let me demonstrate it, I think. Just to make it more clear. Let me show it practically. It's what I was trying to tell you here. Okay. Now this is This is already a downward movement. Let me look for an up. Let me look for. Okay. Let me look. Capture an uptrend movement. Let me capture an uptrend movement. Let me look for a corner. Okay. Let me check on IQ. Okay. Now, now even this IQ delivered. Those who entered in the morning. Yeah, this is good. Now, let me even remove this auto. Me, I love using the manual. Let me first remove the auto, and I capture for you this. Let me remove the auto. Now you see this movement. This is a coin I analyzed in the morning and shared in the group. Now you see this movement. You see this movement, huh? This is where is my, you see this movement from here to here. I will pick my drawing tool, fib level. I will mark that. Okay. Just a minute. I'll mark this. See?
Yeah.
Now, do you know what I expect in the next movement? I want to trade in between. Sorry. I want to trade in between the. Let me add this back and I put this back. If I intend to trade in between the fib levels, you see this? It's unfortunate we are capturing it when the reverse has already happened. The reverse has already happened. This is beautiful, Very beautiful. Very beautiful. Okay. If I had captured this movement like I did in the morning, because I had done that in the morning before I shared, there was a pullback that is happening, yeah? So on drawing the fib retracement, because it is an upward movement, you'll put it on the swing low, and that is your swing high, right? So you put it on the swing low and then drag it to your swing high. That is in case of an upward movement. In case of a downward movement, you put it on the swing high and drag it to the swing low. Now here, like I had done, I'd captured the movement when the retracement was happening. And that's why we got the 3% for those who traded. Oh, I'm saying it because I dropped it in a different group. Sorry, you might have not seen that. But this movement here, if you had captured as a good trader, you would have, if you were going to use a preset price, you would have, because I did that when it was on this other one. You would enter at whatever price you found the market price at, and then you measure that distance from your entry point to capture up to this lower fib level, which is 61.8. That drop is what you are going to distribute as your margin call drop. Okay, you just distribute it there. You distribute it there so that as the price is dipping, you're buying the different levels. By the time it reaches the 61.8 and then reverses, you will begin seeing yourself profiting earlier. Okay, you'll begin seeing yourself profiting earlier. Now there's a lower chance of this. There would be very little chance that the robot will not pick up your trade. Okay, or it will not buy. There's a very low chance. Okay, like in this case, if you're to say you're going to enter at current price, okay, you will know that from whatever point you're going to enter, you already have your support. This is the first support. Okay, the 38.2. But then this would be your target, about 3%, because you're eyeing at the 23.6% fib level as your exit point. You're not going to assume that you will take the 11% at once. First, take up this. If at all the 23.6% fib level does not reject this price movement and it breaks above it successfully, that's when you begin thinking about this target as your next exit point. So you can enter from anywhere and then take that profit. But then in this case, just enter at whatever point, the first resistance point, which is the 23.6, as your exit point. Okay, then you will do the same afterwards. I want you to know this. When you're setting a preset price, like I told the other fellow, use the 38.2. For as long as after you drawing this fib retracement and you find that the price has not yet touched the 38, you use the 38 as your preset. Look at the price that has been put in bracket to use as your preset. Then measure just the distance from the 38.2, okay, all the way to this other fib level of 61.8, okay? Whatever percentage you get there is what you're going to distribute and set for your margin call drops, depending on how many margin call drops margin call limits you would want to establish. That is now up to you. If you don't want to do that at once, just measure. If you want to do that objectively, measure this distance from the 38.2 to the 50%. Okay? That is the first drop you should expect. That in case it misses out on the 38.2% and it doesn't reverse, maybe it goes below, you're actually estimating about 3.8% to reach the next fib level where the reversal may more. So you look at that percentage, putting at the back of your mind that there's a possibility of it hitting the 3.8% to reach the 50% fib level, but also there's a chance that it may just stop midway because it is still within the area. It can also stop within this point. It can also stop within the space between the different fib levels. So because you're not sure, what you only do is you divide the margin call drop into 2. Okay? So maybe 1.5 and then maybe 2%. Capture this distance. Because in case it dips maybe midway and reverses, before reaching the 50%, at least the robot would have bought one time, which is okay, and it is to your advantage. I know you know that now. It will be to your advantage. In one way or another, it would have caused some change in the average, in your average price, and definitely getting loss percentage. Because the whole thing is try as much as possible always to make your robot buy something. Okay, at least let it buy. Take advantage of any small drop. Let the robot at least buy something if the market price drops below the entry price. Let it buy, because it will have a significant effect on the average price. And then eventually on the floating loss percentage, which in the long run will take your advantage, that it will allow you always exit the market earlier than others. Because for you, if the intention was 2%, you will exit earlier than others when they have not yet hit the 2%, because of the effect that the buy order caused on the average price. So always put that at the back of your mind when you're trading. Okay, that's why I always advise that you be intentional, you be measuring these things. Don't just establish this anyhowly. Don't just measure them anyhow. But if you're still not okay with that, normally they give you, they guide you on what you're supposed to do in the signal. Even the one that Leader Julius drops, sometimes he puts 5%, so it is up to you to distribute the 5%. If you want to set it as in only one margin call, it is okay. If you want to distribute it to 5, that is at 111%, it is okay. If you want to put 2, it is okay. But sometimes be intentional. Okay. Yeah, so establishing this would be very important. Okay, it will really be very important. So I hope that is okay. I hope it is okay. If a retracement is happening, consider the first retracement level as the key point to establish your preset. Then the other 2 remaining, just for in case. Just measure the distance, and then the percentage you get is what you should establish for your margin call drop to cater for the scenario of just in case it doesn't reverse immediately at this entry price, which is my preset, and it happens to go down further, I will be covered on the 50%, and I will equally be covered on the 61.8%. So I am all covered. Yeah. So I hope that made sense. I hope it made sense. Okay. I believe so. Okay. So I think that's enough. I hope that is enough for now. Okay. So Leader Julius, please, over to you. Over to you. We have gone so much past our time of stopping.
All right. Thank you so much, Coach Musa, for amazing training. See you all on next week on Monday, same training, same time. See you on the next call, ladies and gentlemen, with Coach Mopiwa, question and answer session. I wish you all the best. In the next close to 45 minutes, the Zoom will be open. The question and answer session by Coach Mopiwa and Leader Jerina. I hope they'll be sharing the links to the different groups. I wish you a happy weekend. Love you all. Have a good day. See you on Sunday at 4 p.m. East African Standard Time for a mega international Zoom call where we shall be having different success stories across the world. The link will be shared in the next few hours from today. I wish you all the best. Have a nice day. Bye, everybody.